5 years from now, somebody's going to look back at SpaceX stock at $200 and say one of two things. Either, I can't believe it was ever that cheap, or I can't believe people paid that much for a company that was still losing billions of dollars a year. Both of those people are looking at the exact same set of facts. Marcus. Okay, that's a little dramatic, don't you think? Priya. It's not dramatic. It's just true. And by the end of this video, you're going to understand exactly why serious credentialed analysts right now today are split almost exactly down the middle on this stock. Not because they disagree on the facts. Because the facts themselves point in two completely different directions, depending on one single unresolved question. We've made 2 videos about SpaceX already. The first one was about the lockup calendar. The second one was about the performance trigger that the rally activated. Both of those videos were about the next 6 months. This video is about the next 5 years. Not the mechanics of the stock, the mechanics of the actual business. Because eventually, the lockup dates stop matching. What's left is just a company. A real company. With real revenue, real costs, real competitors, and real physics standing between where it is today and where it claims it's going. So let's actually do this properly. No hype, no doom, just the numbers, straight from the company's own S1 filing with the SEC, and an honest answer to the only question that matters. Does SpaceX have a realistic shot at being a generational investment? Or is today's price already further into the future than the business can actually deliver? According to the actual prospectus, SpaceX generated $18.7 billion in total revenue in 2025. Picture that as one single company-wide pot of money, then split into 3 very different buckets. The biggest bucket is Starlink, the satellite internet division. It generated $11.4 billion, about 61% of the entire company's revenue, and it produced $4.4 billion in operating profit. That works out to roughly a 39% operating margin, which is genuinely excellent for any business, let alone one that's only a few years removed from being a money-losing experiment. Marcus. Wait, I thought I'd seen a 63% margin number for Starlink somewhere. Priya, you're not wrong. And this is worth explaining clearly because it's exactly the kind of detail that separates a careful analysis from a sloppy one. 63% is Starlink's adjusted EBITDA margin, not its operating margin. Those are 2 different measurements of the same business. Operating margin accounts for the depreciation of Starlink satellites, and SpaceX is depreciating literally thousands of satellites in orbit, which is a real cost. EBITDA margin adds that depreciation back, because EBITDA is designed to show how much actual cash the underlying business throws off before non-cash accounting charges. Both numbers are accurate. They're just answering different questions. Operating margin tells you how profitable Starlink looks on paper after accounting for wearing out its satellites. EBITDA margin tells you how much actual cash it's generating right now. For a satellite business that's capital intensive, the gap between those 2 numbers is normal, not a contradiction. The second bucket is the space segment, primarily Falcon 9 launches, plus heavy Starship research spending. That generated about $4 billion in revenue, but actually posted an operating loss, mostly because of roughly $3 billion poured into Starship development. The third bucket is the AI segment, built around the recently acquired XAI. It brought in a little over $3 billion in revenue, but posted a massive $6.35 billion operating loss. Add it all up, total company adjusted EBITDA for 2025 was $6.6 billion real confirmed cash profit. But the company still posted a net loss of $4.9 billion for the year, and that loss accelerated in the first quarter of 2026, with the company reporting another net loss of roughly $4.3 billion in just 3 months. Marcus. Loss and burn aren't quite the same thing though, right? Priya. Good catch, and it's worth being precise about. A net loss is an accounting figure. It includes things like depreciation that don't actually involve cash leaving the building in that exact moment. Cash burn is what's actually disappearing from the bank account. SpaceX's actual cash burn is driven heavily by capital expenditures, which we'll get to in a minute, and that number is even larger than the net loss figure suggests. So when we say the company lost money, we mean the accounting picture. When we say the company is burning cash, we mean the treasury picture. Both are true, they're just not identical, and treating them as the same thing would be sloppy. So here's the picture in plain terms. Starlink is large, fast-growing, and genuinely profitable on every measure that matters. The rest of the company is still spending enormous amounts of money on a rocket that hasn't proven its commercial case yet, and an AI division that's burning billions while still building out its infrastructure. The entire investment thesis for SpaceX, 5 years out, depends on whether those second and third buckets catch up to the first one before investor patience runs out. Now let's talk about valuation, because this is where the real disagreement begins. SpaceX went public at a $1.75 trillion valuation. At today's price, the market cap sits closer to $2 trillion. Against that $18.7 billion revenue figure, that's roughly 107 times revenue. At the brief $2.2 trillion peak after the IPO pop, that climbed closer to 125 times revenue. Either way, that's a multiple that assumes, not hopes for, assumes a future that hasn't happened yet. Marcus. Okay, but every fast-growing company gets a premium multiple early on. Amazon traded at crazy multiples in the 90s too. Priya. That's completely fair, and it's actually the core of the bull case. The question isn't whether SpaceX deserves some premium. The question is how big, and that's exactly where professional analysts split into two camps. PitchBook, a respected institutional research firm, modeled SpaceX over a 5 to 7 year horizon and arrived at a fair value range of $1.1 to $1.7 trillion, reasoning that the valuation becomes easier to justify as Starship commercializes and the direct-to-cell phone business scales. Morningstar, an equally respected independent firm, ran its own model and landed at $780 billion, less than half of today's price. Morningstar's own long-range model, looking out to 2040, projects Starlink alone reaching $150 billion in revenue with 70% margins. That's an enormous number, and their model still says the stock is overpriced today, because even a huge number far in the future has to be discounted heavily to find out what it's worth right now. Then there's Goldman Sachs, projecting SpaceX's revenue could surge roughly 100 times by 2030, with total adjusted EBITDA reaching $352 billion. More than half of that projected growth comes from the AI division, built around a claimed total addressable market of $26.5 trillion. An addressable market is the size of the room, not a guarantee of how much of it SpaceX actually wins. Goldman's own framing treats this as an aggressive scenario, not a baseline expectation. Wall Street's actual current price targets show the same split. Oppenheimer has an outperform rating with a $190 target. New Street Research sits at a more neutral $165. CFRA has initiated coverage with an outright sell rating and a $115 target. Marcus. Those are wildly different numbers from professionals looking at the same company. Priya. That's the whole story in one sentence. And it's worth noting, some professional investors would say price targets like these are almost beside the point. They're one analyst's 12-month opinion, not a full discounted cash flow model. The real disagreement isn't really about the price target number itself. It's about the assumptions feeding into each model, how fast Starship commercializes, how much the AI segment is really worth, how long Starlink keeps compounding at this pace. Two analysts can plug wildly different assumptions into the same valuation framework and land on numbers that look nothing alike, even while using sound methodology. When credentialed analysts disagree this much, it usually means the market hasn't actually figured out how to value the company yet. This brings us to XAI, because in February 2026, SpaceX completed its acquisition of Musk's AI company, valued at roughly $250 billion. That transforms the public narrative from a rockets and internet company into a combined space and AI infrastructure platform. Morningstar specifically flagged this acquisition as adding business integration complexity that's difficult to underwrite, meaning it's genuinely hard for an outside analyst to confidently model how two very different businesses combine into one coherent 5-year projection. You're not just betting on rockets anymore. And the capital being poured into that AI bet is staggering. According to the S1, total company capital expenditures rose from $11.2 billion in 2024 to $20.7 billion in 2025, with more than half of that roughly $12.7 billion, going toward AI infrastructure alone. In the first quarter of 2026, AI capital spending hit $7.7 billion in 3 months. Marcus. So the gap between what the company earns and what it spends is enormous. Priya. It is, and here's the honest way to frame that gap. Because EBITDA isn't the same thing as free cash flow. It doesn't account for taxes, interest, or changes in working capital. So the real cash shortfall could differ from a simple subtraction. But directionally, adjusted EBITDA of $6.6 billion against capital expenditures of $20.7 billion shows a real multi-billion-dollar funding gap. And that gap is being covered through debt and new equity raises, including a disclosed bridge loan from Morgan Stanley and roughly $1.9 billion in annual interest expense. This matters for one specific reason. Every time a company raises new capital by issuing additional shares rather than relying on its own cash flow, existing shareholders end up owning a smaller slice of the company than they did before. That's dilution, and it's a real cost worth knowing about. But it's not automatically bad. If that capital gets deployed into assets that generate strong future returns, profitable satellites, a working Starship, a valuable AI platform, dilution today can still mean a more valuable share 5 years from now, even though you technically own a smaller percentage. The honest takeaway isn't dilution is bad. It's the return on the spending isn't proven yet. And until it is, you're taking that risk on faith. And here, candidly, is the single most important sentence in this entire video, reported directly from disclosures tied to the IPO. Musk has reportedly described a genuine risk of bankruptcy if Starship fails to sustain a launch cadence of at least once every 2 weeks. Marcus. Musk himself used the word bankruptcy. Priya. In that specific context, yes. And it reframes everything about Starship's track record. This isn't simply the Mars mission might slip a year. According to the founder's own warning, the financial model underlying this company depends on Starship hitting an aggressive, sustained cadence. It doesn't mean bankruptcy is likely. SpaceX has a profitable Starlink division and enormous contract backing. But it does mean the gap between the bull case and the bear case isn't just about growth speed. In a worst case, the founder himself acknowledged, it's about whether the company's biggest bet succeeds at all. Now, let's talk about the parts of this business that are working right now, with no asterisk attached. SpaceX controls somewhere between 80 and 82% of the entire global commercial launch market. In terms of actual mass carried to orbit, SpaceX accounted for more than 80% of everything humanity sent to space in 2025. The next largest competitor carried roughly 12% of what SpaceX carried. Marcus, how does one company get that far ahead? Priya, reusability. A single Falcon 9 booster has flown as many as 28 times across a fleet approaching 600 total launches, with success rate above 99%. The internal cost of flying one Falcon 9 mission is somewhere between $15 and $30 million. Competitors without reusable rockets are often charging customers $60 to $80 million, sometimes well over that for comparable missions. That's not a small edge. It's a cost structure most competitors mathematically cannot match without building their own reusable rocket from scratch, which takes years and billions of dollars. There's also a flywheel here worth understanding. Roughly 2/3 of Falcon 9 launches now carry SpaceX's own Starlink satellites, not outside customers. Starlink's revenue funds more launches. Those launches deploy more satellites. Better coverage attracts more subscribers. More subscribers fund the next round of launches. No competitor can replicate that loop without owning their own reusable rocket fleet. And right now, nobody else does at this scale. There's also a newer, less discussed revenue category that's grown sharply in the past year: government and defense contracts. SpaceX has accumulated more than $22 billion in cumulative federal awards and recently won several major contracts tied to the Golden Dome missile defense program, including one worth more than $4 billion to build missile tracking satellites, and another worth roughly $2.3 billion for the communications backbone connecting the whole system. This matters because it's revenue that doesn't depend on Starship working or XAI paying off. It's federal budget money flowing into infrastructure SpaceX already knows how to build. The risk here is political rather than technological. Defense priorities can shift, And concentrating this much national security infrastructure with one contractor has already drawn some criticism in Washington. Starlink itself has grown from 10,000 beta users in 2021 to over 10 million paying subscribers across 164 countries today. That growth is real and backed by genuinely profitable unit economics. Starlink's nearest competitor, Amazon's rebranded satellite service, has deployed somewhere between 180 and 280 satellites against Starlink's roughly 9,600. Amazon has deep pockets and a regulatory deadline pushing it to move fast, but it's years behind. Now for the hardest part of this story, Starship. Starship has completed multiple successful integrated flight tests with full reusability. That's a genuine engineering achievement. But here's the honest pattern worth knowing. Musk first targeted a Mars landing for 2018. That slipped to 2022. By 2024, the target had shifted again to an uncrewed mission in 2026, with crewed missions following between 2028 and 2030. Marcus. So the date keeps moving. Priya, every time in the same direction. The current plan involves sending several uncrewed starships toward Mars during the late 2026 transfer window, carrying cargo and, notably, a small fleet of Tesla's Optimus robots meant to test whether they can operate on the Martian surface ahead of any human mission. If even one ship survives the trip and transmits data back, that's historic. The first time a private company has delivered hardware to another planet. But the orbital refueling demonstration this entire mission depends on hasn't been performed even once yet, and Musk himself has put the odds of hitting that specific window at roughly 50-50. That's a far more honest framing than the confident headlines that sometimes circulate, and it deserves to be taken at face value, since it comes directly from the person setting the timeline. This matters enormously for valuation, because the gap between Morningstar's $780 billion fair value and PitchBook's $1.7 trillion fair value comes down almost entirely to how much credit you give Starship for hitting its targets on time. If it slips another 2 or 3 years, which history suggests is a real possibility, that pushes the bull case further out, and money further out in time is worth less today. There's one more piece of context worth sitting with before we reach a conclusion, and it's something most excited coverage of this IPO skips entirely. How have other massive, high-multiple IPOs actually performed? Rivian raised $11.9 billion in 2021 and briefly touched a market value, over $100 billion, within 2 days. Today it trades around 85% below that peak. Snowflake, the largest pure software IPO at its debut, trades roughly flat to down from its first day closing price years later. One detailed review found a median first-year maximum decline across major tech IPOs of the past decade was 54%, and the more speculative names fared worse. Robinhood fell 90% from its peak, Rivian 88%, Lyft 79%. Marcus. But SpaceX isn't Robinhood or Lyft. It's a real dominant company. Priya. Completely fair and an important distinction. But here's the data point that applies most directly to SpaceX. At its brief $2.2 trillion peak against $19.3 billion in trailing revenue, SpaceX traded at roughly 115 times sales. For comparison, Palantir currently holds the highest valuation multiple in the entire S&P 500 at 59 times sales. SpaceX was priced at roughly 95% more expensive than the single most expensive company in that index. Very few companies in market history have ever sustained a sales multiple above 100 times for long, and none have maintained it indefinitely. Tesla itself took roughly a decade after its own IPO, including several brutal stretches down more than 50%, before the long-term bull case it's known for today actually arrived. Marcus. So even if SpaceX turns out to be right about everything, the timing might still be brutal for someone buying today. Priya. That might be the most important sentence in this entire video. Being right about a company's long-term direction and making money on the stock you bought are two different outcomes, and the gap between them is usually filled with exactly that kind of multi-year drawdown. So here's the honest, balanced answer, and we're not going to soften it in either direction. The bull case is real. Starlink is genuinely profitable with a multi-year head. No competitor is close to matching. The launch division controls over 80% of the global market. Government and defense spending has opened a new revenue category that doesn't depend on Starship or XAI succeeding at all. If Starship reaches commercial maturity anywhere close to schedule, the cost economics could unlock entirely new markets. Two independent research firms, using different methods, still arrive at fair values in the hundreds of billions to low trillions. That's two credentialed firms saying a version of this story can plausibly work. The bear case is equally real. The company is burning billions a quarter, funding much of it through debt and new share issuance, which carries real dilution risk. Musk himself has reportedly tied the company's survival to Starship hitting an aggressive cadence. The valuation assumes a level of success that Starship specifically has not delivered on schedule across nearly a decade of announced timelines. History's track record with massive, high-multiple IPOs leans heavily toward painful multi-year drawdowns, even for companies that eventually succeed. And professional price targets right now range from $115 to $190, which tells you the market itself hasn't settled on what this is worth. Marcus. So what do we actually do with that? Priya. There isn't a single answer, and anyone who gives you one with total confidence is selling certainty that doesn't exist in the data. If you believe Starship commercializes close to its timeline, if you believe the XAI integration creates real synergies, and if you're comfortable holding through years of continued losses while that plays out, the bull case is genuine, credentialed support, not certainty. Support. If you're skeptical of founder timelines given the track record, if you think the AI division adds risk before proven revenue, and if you think 100+ times revenue multiple is pricing in a future further away than today's price suggests, the bear case also has genuine, credentialed support. Also not certainty. Also support. What you shouldn't do is treat today's price swings as evidence of the actual 5-year outcome. That's noise sitting on top of a genuinely unresolved long-term question, one that resolves over years, not on a calendar date. As Starship either hits its milestones or slips again, as Starlink either holds its lead or faces real competition for the first time, and as the XAI acquisition either becomes a genuine second growth engine or the complexity Morningstar warned about. Watch Starship's actual flight cadence over the next 12 months, not the announced dates, the actual results. Watch whether Starlink's growth holds as Amazon's constellation comes online. Watch whether net losses start narrowing or keep widening as AI spending scales. Those three things, tracked honestly, will tell you more about the real 5-year outcome than anything in this week's stock price. If this kind of breakdown is useful to you, both sides, with real numbers instead of a pick and a script to match it, subscribe, because we're going to keep tracking exactly those three things as the actual data comes in.